Many proactive investors and wealth managers use advanced strategies to protect their stock investments. These hedging strategies can be complex and difficult to implement, but they can be an effective way to reduce stock market risk. What are these strategies all about? That's what I'll be sharing in this video. Hi, my name is Camille Gaines. Welcome to Retire Certain. This channel is all about helping people first build wealth with slightly alternative methods that don't take decades, and two, creating diversified income streams so you can live well. I'm not a financial advisor, so I'm not trying to sell you wealth management services or act as one. I'm an accredited financial counselor, a bit of an investing nerd, but mostly I just share what I've learned from personally investing for almost 40 years and from creating diversified income streams over the past 15 years. So as a disclaimer, I must say, do your own research and hire a financial advisor if you feel like you need one. Now, back to advanced strategies to lower stock market risk. And it's important for you to kind of be aware of these strategies, even if you don't want to use them, which I wouldn't encourage you. This isn't something I'm promoting necessarily, as I think it's important to be aware of them. And if you work with a financial advisor, a wealth manager especially, you may see some of these strategies, and it's important to know about them. The first strategy is buying inverse stock ETFs. Inverse stock market ETFs move in the opposite direction of stocks. In other words, when the stock market is falling, inverse ETFs are rising. Inverse ETFs can work well, but the timing can be really tricky. They are probably best saved for very advanced investors and financial professionals. Another strategy that's common among financial professionals and proactive investors is to what is very appropriately called a protective put strategy. Now, you've probably heard of a protective put, but here's how a protective put works. A put is a type of option contract, a stock option. A put option gives the owner of the put the right to sell a stock to the option buyer at a defined price, a certain price, called the strike price. Additionally, the stock has to be bought on a certain date called the option expiration date. Here's the thing. Put options move in the opposite direction of the stock market. Similar to inverse ETFs, when stocks go down, stock market puts usually go up. There are puts that represent the overall stock market, such as the S&P 500 index. There are also puts that represent individual stocks. So inverse stock ETFs and protected puts are two common ways to avoid losing money in stocks when they are falling. Again, since these strategies are tricky to time just right, this is something most investors would want to use a financial professional to implement for them. There are also funds that use these strategies. Normally, I talk here more about investing strategies that I've used in the past or that I like to use often. And while I have used both puts and inverse ETFs in the past, this is not something that I frequently do as an investor. Instead, I really prefer other strategies I talk about here, and that is to avoid overvalued investments. Sometimes this costs me a little bit by missing opportunities on the upside, but I've defined the type of risk I want that I'm okay with, and I try to then invest within those limits. And doing this, it helps me feel more at peace with investing. It's especially important at this time in my life. Note that even in the best investors are challenged to consistently create a perfectly hedged portfolio using these strategies that I've mentioned. A simple and very common way to hedge stock losses in your portfolio is to just own investments that go up when stocks tank. For example, when you have a portfolio of stocks and low-risk bonds, you're hedging against your stock market losses within your portfolio. This is because quality bonds almost always go up when stocks go down. I've done a video about this, and I've also written an entire article about this on my website at retirecertain.com. If you want to read it and see the table that I made with this information, I think you could probably just Google what goes up when stocks go down, and I think it'll come up on page 1 at least. Again, the only way to completely avoid stock market losses is to not invest in stocks or to have a perfectly hedged portfolio, which is rare, if not impossible. That's why I really prefer investing around long-term market cycles and in undervalued assets. It's just an easier way to invest. It's a lower risk way to invest. By defining acceptable stock market risk and investing with an awareness of market cycles and valuations, investors can at least mitigate stock market losses, or even better, they can invest profitably in the stock market. If you want to learn more about stock market cycles, watch this video next. And remember, build wealth, create income streams, and live well.